As we have this conversation with Marc Lasry, the Avenue Capital Chairman and CEO, joining us now. Welcome back.
Thank you very much. How you doing?
I'm doing well, thanks. I'm wondering just what you think of rates here, post-Fed. Do you think they've overstayed their welcome?
Look, I think rates are going up. I mean, we've thought that for a while. So we think it's going to continue to go up. I mean, the economy's doing great. We'll just see what happens. But it's kind of hard when you're growing as fast as we're growing this year for rates to stay where they are.
When do you think they should raise rates?
Oh, if you're asking me, they should do it tomorrow, but they're not asking me. So I think ultimately it'll start moving up over the course of the year. But it's kind of hard, again, if you've got an economy that's doing as well as it is right now, why rates shouldn't be higher. I mean, you need to sort of slow things down a little bit. But I think ultimately people are going to want rates to remain kind of low so that the economy keeps on doing great.
I'm wondering how this all has impacted you in your wheelhouse of distressed credit, whether it's taken some opportunities off the table because of the Fed's engagement, and they've been involved for such a long period of time now, and they don't seem to be anywhere close, I think it's fair to say, to taking any punch out of the punch bowl.
Yeah, and I think you're right. I mean, I think that's exactly what's happening. I think for us, it's, especially in the U.S., it's been harder. You've got to find special situations. I would tell you earlier, we were able to do specialty lending and we were able to charge somewhere around sort of, I'd say 12, 15%. That's had to come down. And now we're charging less. And I think that's everywhere. There's less distress. There's just more capital out there. So for us, we've got to go abroad. We need to do things in Europe. We need to do things in Asia. And we need to find special situations here in the U.S. But there's less than there was, I would tell you, obviously, a year ago.
Sure. I mean, it's interesting. Does that equation change at all if and when the Fed makes its move, or if and when rates make a meaningful move higher?
Yeah, it'll change. I mean, that's actually, if the Fed is looking to help my business, what they should do is just raise rates.
Yeah. No wonder why you advocated for that.
So I don't think they're going to do that. But I think, look, for the well-being of the economy, you want rates to stay where they are or, move up very slowly. The quicker rates move up, the more issues you will end up having, because then capital becomes more expensive.
Yeah. It's interesting. I wonder your perspective, too, on what we've seen in some of the so-called meme stocks, right? There was a time maybe a year ago where you would look at bonds and say an AMC and think, OK, maybe there's an opportunity there. But then you have this really unique scenario in which a company that would theoretically be distressed would have the ability, because of the meme mania, to actually raise capital and change the calculus on its business, which may in turn change the opportunity that you would have seen prior. What do you make of that?
I think you hit it on the head. I mean, I think that's actually what's happened. A lot of companies that actually had issues or have issues, that aren't making money, or EBITDA number is very low, which would be a huge opportunity for us, their stock is trading at pretty high levels. So if you're the company, what do? You just issue stock and you pay down debt. And so the opportunity set for us because of that has gone down. Now, look, I think that's great for the economy. I think it's great for equity investors. It's great for companies. It's not great for us, but that's okay. I mean, reality sooner or later sets in. And hopefully that'll happen towards the end of this year or the beginning of next year.